Hello traders.
Rigtig godt nytår. Velkommen til den første episode i 2021. Håber du kom rigtig godt ind i det nye år. Og velkommen til de nye abonnenter. Jeg bukker og takker for supporten. I denne udgave skal du ikke lytte til mig, da jeg synes vi skal begynde året med noget inspiration. Derfor vil jeg overlade ordet til nogle af verdens dygtigste tradere gennem tiden. Og om du er ny i markedet eller har været der længe, så er der en masse vigtige guldkorn til dig, der virkelig gerne vil lære eller genopfriske din viden. Trading er ikke flashy eller sexet på nogen måde, og de klip, du skal se, vil måske virke lidt gamle og grå. Men du skal ikke lytte med dine øjne, og de råd, du får her, er stadig super aktuelle den dag i dag. Watch and learn.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double nits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000, that fool, at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1 1/4. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know, the important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. You know, you have to deal with the stock and say, I understand the company, and if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is, the stock does not know you own it. This is a breakthrough. So don't get, you have to understand it and say, they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day.
I've told particularly young people in the office who are really petrified by this market decline that it's the best thing that ever happens to them. And if you think about it logically, of course it's wonderful. I mean, think of, say, the young man I was talking to yesterday is probably 25 or 26 years old, and he's got the rest of his life in invest. And I said, well, let's suppose that Chris Scott, his name is, I said, let's suppose, Chris, that the market's going to end up at Jim Glassman's 36,000 by the time you retire. Do you want to be investing all your money when the Dow is at 35,000, or invest it all when it's 9,000? Just think about that for a minute. In other words, you want a long time to invest at low prices, and it's certainly a frightening advantage for those of us who have some money at work in the market today to think of this as a blessing. But it is a blessing because in the long run, investing depends on accumulating money at sound prices and not inflated prices like we have. I also think the general economy and the financial markets are well served by a return to reality. When you leave reality and depart from the laws of gravity, there's nothing but bad things that can happen, and the higher you fly, the more you fall. We flew quite high enough, and I think it's a blessing, maybe a blessing in heavy disguise, a blessing that we've come back a little bit toward the ground.
The checklist you kind of go through.
So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading? And if there's a wide gap between price and value, you can buy it for 50 cents, it's worth $1.20, well, then we're going to take a hard look and try to understand why it trades at a deep discount.
So Dr. Elder, when everybody says know the psychology of the market or learn the psychology of the market, what do they really mean?
I don't know what they mean. I can tell you what I mean. I think market psychology is divided really into two huge areas: individual psychology of trader, and mass psychology of the markets. In terms of individual psychology of traders, I think that all of us come to the markets with a wonderful goal to make more money than we can get from a treasury bill. But along the way, most of us lose focus and we start trading for entertainment. I think that financial markets are the most entertaining places on the face of this earth. It's like a horse race, card game, chess game, all rolled up in one, and it goes 24/7. You can always find action. And so people who are bored, stressed, hate their lives, they escape into trading and they're immensely entertained by it, but they don't make money. When you want to be entertained, you have to pay. You cannot make money. Successful trading is a little bit boring. And that's why my best advice for somebody who wants to become a cool, calm, disciplined, successful trader is keep written records. I hate keeping written records. I'm bored by written records, but that's what makes me into a serious trader.
Now, I've heard you say something like buy happy markets and sell depressed markets. Did I get that right?
You got it. When markets are happy, that's when they top out, and that's when they go down. When markets are depressed, that's when sellers come out of the woodwork and everybody sells the markets, and eventually there are no more loose shares to be sold, and so depressed markets bottom out. We have indicators which help us identify happy markets and sad markets, depressed markets. When a market blows out of its channel, when a market creates a bearish divergence, when you hear this happy news of IPOs, well, that's a happy market. And that's when I start looking for shorting opportunities. When a market is depressed, when it falls out below its lower channel line, as the stock market has done about a week ago, when the news are gloomy, that's when I become interested in creating a shopping list.
What about these sentiment indicators, put call ratios and commitment of traders, that sort of thing?
Put call ratios, commitment of traders, also not to be forgotten, VIX. I don't think it was Shakespeare who wrote this poem. When VIX is low, go slow. When VIX is high, it's safe to buy. VIX is a fear index. So when VIX is high, fear is rampant. That's a safe time for buying. When VIX is low, the crowd is complacent, and that's a dangerous time. And by the way, one of the troubling things about the market today is that after this decline we've had since late April, VIX has never picked up. VIX is still at 20. The crowd is complacent. The crowd is not fearful. And that's why I'm quite cautious about what's happening today. I don't think we have seen the bottom of it yet.
Dr. Adler, thanks for your time.
Thank you.
I have an old-fashioned belief that I only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business.
And all we have are conversations of what makes sense. Like, everybody has the right to make sense of things. Okay, now in that environment, I get to see how differently people think. I realize how radically different people think. And so that was a curiosity to me. Because it's masked. You have no idea what's going on behind other people's eyeballs. They're in their heads. They all look a lot alike, but their brains work so differently. So that led me to brain science. In other words, so I was very, very interested in understanding literally how the brain works and the physiology of the brain. And and we have different physiologies. So what we think is just our interpretations.
Sometimes it's not what you invest in, it's what you don't invest in, and I only make 1 or 2 big trades a year. And I think my story just proves that there's never a bad time to make a great investment. I think that story is ever more important as we look forward to 2013, not knowing exactly which way the markets are going to take us. And I actually turned 20,000 to 2 million from 2007 to 2010 in the middle of the worst financial turmoil we've had in the country in decades. And the way that I did it was just learning how to retrain my mind to identify game-changing things in real life that were having game-changing impacts on publicly traded companies. And the trick here is to understand when you see something in your life that Wall Street hasn't picked up on yet. And that's when you have an opportunity to make an information arbitrage investment. Now, the moment that Wall Street starts talking about that thing that you picked up on days, weeks, or months earlier is when you exit the investment. And that really is what my methodology is all about, just living your life and learning how to see things that could correlate to investment opportunities on Wall Street.
So, say the first chapter. The first chapter's theme is failure. That's a good place to start. Failure is something that a lot of people get very dismayed about. Obviously, it's not a pleasant thing. The lesson in that first chapter, though, is that there have been many great traders that I've interviewed who failed miserably at the beginning, sometimes multiple times, and yet succeeded enormously. And that was because they still believed that they had what it took, that it was just a matter of keeping at it and they had the perseverance to do it, and they did have the talent and skill. So the lesson is, just because you experience early failure does not mean that that's a prediction of what's going to be the future. Now, it doesn't guarantee you to be successful either, but it is hopeful to know that a lot of super successful people did not start out that way.
How important is risk management? It seems like it's the longest chapter in the book, so you seem to stress it in your investment philosophy.
I'm glad you mentioned it's the longest chapter, and it's the longest chapter for a couple of reasons. One, there's a lot to say about it, maybe more than a couple of reasons. Secondly, most investors downplay it. Their perception is, oh, trading. If I want to be a great trader, it's all about finding this great method of entering trades. I got to be smart than anybody else getting into trades, and they'll spend 95% of their time on how to enter trades, and 5% on how to get out. But what I found is that the traders who are really successful worry much more about how they're going to get out and not losing too much and conserving their capital than they worry about making the money. They're really much more concerned about not losing than they are about making money. And virtually all of them will tell you that risk management is more important than the entry method.
Another lesson is exit points, knowing your exit points. Can you give us insight as to some of the great traders? And
Sure.
Do they have predefined exit points, or do they?
Yeah, it's critical, is the predefinition part. Bruce Cumner of Caxton, one of the great traders of all time, his line was, I always know where I'm going to get out before I get in. And the idea there is, well, why is getting out, knowing when you're getting out before you get in, so important? Because before you're in a trade, that's the only time that you have objectivity. As soon as you're in a trade, you lose objectivity. So he decides, okay, I expect this to happen in the market. I expect the market to go here, but it shouldn't go, I expect it to go to X, but if it starts going the other way, it should not get to Y. If it goes to Y, I'm wrong. And so he decides what that point Y is, and that's where he'll be getting out regardless. And so he doesn't have to second guess himself. He doesn't have to agonize. He's already made his decision. And by knowing where Y is, he knows what his risk on the trade is and how much he can stand to lose.
Jeg håber, de mange gode råd fik dig til at tænke og overveje nogle ting. Og ikke mindst i hvert fald, at du føler dig inspireret. Del gerne i kommentarfeltet, hvis du selv har nogle gode quotes fra nogle af de store, eller selv har nogle tanker, du plejer at holde dig til, og som du også synes hjælper dig i markederne. Tak fordi du kiggede med.